Did you know that the top 1% of earners save and invest over 70% of their income, consistently outpacing the rest of us? These financial habits aren't just lucky breaks. They're backed by data and proven strategies. If you're tired of feeling stuck and want to learn how the wealthiest grow their money, this video is your game changer. By understanding these habits, you can start shifting your financial future today. So, if you're serious about leveling up your money game, make sure to like and subscribe for more tips. Now, let me show you why this is so urgent and what you need to know before getting started. Welcome. Today, we're exploring the money habits of the top 1%, backed by data. We'll uncover how these wealthy individuals save, invest, and grow their wealth, practices that set them apart from the rest. Understanding these habits matters now more than ever, especially in the current U.S. economic climate, where economic uncertainty and inflation challenge everyday financial stability. Whether you're a beginner just starting your financial journey or someone with some experience looking to improve your strategies, this video is for you. By the end, you'll know the proven behaviors that help the ultra-wealthy maintain and increase their wealth, and you'll learn practical steps to start applying them today. This isn't about luck, it's about habits rooted in data and proven results. So, if you're ready to transform your financial future, stay tuned. But to make smart decisions, you first need to understand the economic landscape we're dealing with. In today's economic landscape, understanding the environment that shapes the financial habits of the top 1% is more crucial than ever. According to data from the Federal Reserve, the U.S. economy has experienced significant fluctuations over the past few years, driven by inflation, interest rates, and market cycles. Inflation, which reached 8.5% in 2022 as reported by the BLS, erodes purchasing power and impacts savings and investments, forcing even the wealthiest to adapt their strategies. Interest rates have fluctuated dramatically, with the Federal Reserve raising them multiple times to combat inflation, affecting borrowing costs and investment returns. Higher interest rates make borrowing more expensive, but can also increase yields on savings and fixed income assets, influencing how the top 1% allocate their wealth. Meanwhile, tax policies and housing market shifts, as indicated by the Fred database, create additional layers of complexity. For instance, rising property values and fluctuating home prices impact wealth accumulation and estate planning for the wealthy. Market cycles, from bull to bear markets, also play a critical role. During downturns, the top 1% tend to leverage their access to data and sophisticated strategies to protect and grow their assets, often capitalizing on opportunities others might miss. Understanding these macro factors helps us see why their financial habits are rooted in data-driven decisions, resilience, and adaptability. With that context in mind, let's break down the strategy you can actually apply. The main strategy of the top 1% when it comes to managing their money is to stay informed and adapt quickly to the changing economic environment. They don't just rely on intuition. Instead, they analyze data, understand market trends, and make strategic decisions based on that information. This approach helps them protect their assets and find new opportunities to grow wealth. A key part of their process is investing wisely. They diversify their investments across different assets, such as stocks, real estate, and businesses, to reduce risk and maximize potential returns. They also pay close attention to interest rates and inflation because these factors influence how much their money grows or loses value over time. When inflation is high, for example, they may shift their investments to assets that tend to outperform inflation, like real estate or certain stocks. Saving is also crucial, but it's not just about putting money aside. It's about making your savings work harder through smart choices like high-yield accounts or investment funds. Leveraging or borrowing money strategically allows them to buy larger assets or invest more without depleting their cash reserves. They use loans or credit lines carefully, ensuring that the returns they get from these investments exceed the cost of borrowing. To succeed, they focus on understanding key terms like inflation, interest rates, diversification, and leverage, concepts that help them make smarter decisions. By staying disciplined and informed, they can navigate market cycles and economic shifts effectively. Now let's look at a real-world example to see exactly how this plays out in practice. Imagine you're considering buying a $500,000 home in the United States. Using a mortgage calculator, you find that a 30-year fixed loan with a 3.5% interest rate would require monthly payments of about $2,245, including taxes and insurance. To put this into perspective, a typical investor in the top 1% might put down 20%, which is $100,000, and finance the remaining $400,000. Over the life of the loan, you'll pay roughly $273,000 in interest, but your property could appreciate at an average rate of 3% annually. In 5 years, the home's value might increase to approximately $579,000, thanks to steady market growth. Meanwhile, your monthly payments remain consistent, allowing you to leverage your capital wisely, using the mortgage to free up cash for other investments, such as stocks or business ventures. By managing the mortgage wisely, you're not just paying for shelter, you're turning the property into an appreciating asset that helps grow your net worth over time. The key is understanding how to balance debt and investment returns, ensuring your leverage works in your favor. This looks great, but only if you avoid the common traps that ruin deals like this. Many people aspire to join the top 1% of earners and wealth builders, but common mistakes can hold them back. First, poor credit management is a major pitfall. For example, someone might skip paying bills on time or max out credit cards, damaging their credit score and increasing borrowing costs. Maintaining a strong credit profile is essential for better loan terms and financial opportunities. Second, overpaying for investments or services is another trap. People often choose convenience over cost efficiency, like paying extra for financial advice they don't need or for insurance with unnecessary coverage. Being diligent about comparing options can save thousands. Third, skipping due diligence when making big decisions, such as buying a property or starting a business, can lead to costly mistakes. Rushing into investments without research or ignoring market trends can jeopardize long-term growth. Lastly, many overlook the importance of diversified investments. Relying heavily on one income source or asset class can increase risk. Instead, spreading investments across stocks, real estate, and other assets helps protect wealth over time. To avoid those mistakes, here are the best tools and resources available right now. To start building wealth like the top 1%, it's essential to leverage the right tools. First, consider Credit Karma. It offers free credit score tracking and personalized tips to improve your credit health, which is crucial for better loan terms and financial opportunities. Next, use Investopedia for comprehensive financial education. Understanding concepts about investing, taxes, and personal finance empowers smarter decisions. For investing itself, platforms like Fidelity, Fidelity.com, and Charles Schwab, Schwab.com provide user-friendly options for diversified portfolios, low fees, and research tools to help you grow your wealth wisely. If real estate is part of your plan, Redfin.com, offers detailed property listings and market insights, making it easier to evaluate investments or find your next home. These platforms are backed by data and designed to support disciplined financial habits, helping you manage, grow, and protect your wealth effectively. Now that you've got the tools, let's talk about the first thing you can do today to get started. Today, take a simple but powerful step. Download a free app like Credit Karma and check your credit score. It only takes a few minutes, but this small action unlocks a clearer picture of your financial health. Understanding your credit score is the foundation for better loan terms, lower interest rates, and greater opportunities to grow your wealth. By seeing where you stand, you can identify specific areas to improve, giving you control over your financial future. This step creates momentum. Once you know your score, you can set a realistic goal to boost it, whether that's paying down a debt or correcting any errors. Each small action builds confidence and moves you closer to the top 1%. Remember, even the most successful people started with a simple step like this. Today's effort is just the beginning. Imagine what you can achieve by consistently monitoring your progress, making smarter choices, and staying disciplined. Every big financial goal is reached through small, deliberate actions taken every day. Taking that first step is how every long-term success story begins. Let's look at what happens when you stay consistent. As you keep building good habits, your financial resilience grows and your path to wealth becomes clearer. The journey to joining the top 1% starts now, one small, achievable step at a time. Imagine yourself 5 years from now. You've been consistently monitoring your credit score, saving a little each month, and investing wisely. By 2028, you could own your first rental property, generating steady cash flow. This small step, repeated month after month, begins to compound, building a foundation for financial freedom. Fast forward 10 years. With disciplined, saving, and strategic investments, you might own 3 or 4 income-generating properties, each contributing to your financial stability. Your credit health has improved, opening doors to better financing options, and your financial knowledge has grown. The power of consistent effort is clear. Small, smart actions compound over time into meaningful wealth. Now look ahead 30 years. If you stay committed, those initial investments and savings could lead to owning 5 or more properties that generate passive income. Your credit score is excellent, and your portfolio reflects years of steady growth. At this point, you're not just building wealth, you're creating a legacy. What's powerful here is that none of this requires overnight success or extraordinary luck. It's about staying consistent, making informed decisions, and trusting the process. And now that you see what's possible, here's how we wrap this up and take action. Understanding and adopting the money habits of the top 1% is all about consistent small actions, tracking your credit, saving diligently, and investing wisely over time that compound into lasting wealth. Remember, the journey from setting your first financial goal to owning multiple properties and building passive income is a marathon, not a sprint, and every step counts. Thanks so much for watching and celebrating your progress. Every small move brings you closer to financial freedom. Keep that momentum going. If you found this helpful, don't forget to like, subscribe, and drop a comment below. What's your first financial goal for this year? I'd love to hear your plans. And if you want to dive deeper, check out our video on smart investment strategies for beginners. Stay consistent, stay confident, and keep building that future because your wealth journey starts today. Thanks for being part of the community, and I'll see you in the next one.